The next topic is currency pair correlation, and will be important to your day-to-day trading. The term correlation, when reference to the Forex market, means to move in the same direction. When two or more currency pairs contain the same currency, they will generally show correlation. Some currency pairs are highly correlated and others are not. Currency pairs that contain the US dollar are generally highly correlated. If the US dollar weakens, then generally the currency pair shown on the left hand side will rise, and the currency pair shown on the right hand side will fall. If the US dollar strengthens, then generally the currency pair shown on the left hand side will fall, and the currency pair shown on the right hand side will rise. Currency pairs that contain the Japanese yen are also generally highly correlated. If the Japanese yen weakens, then generally all these currency pairs will rise. If the Japanese yen strengthens, then generally all these currency pairs will fall. So why is correlation important? For example, if I was thinking of buying the Aussie Japanese yen, I would like to see that all the pairs of the Japanese yen are rising so that I'm trading in line with the market correlation. This will give me a greater chance of success when I'm trading, because I'm trading in line with the dominant trend of the Japanese yen.